I'm going to be direct with you right from the start because we don't have time for pleasantries. My name is Ray Dalio, and I've spent over 5 decades studying economic cycles, building Bridgewater Associates into the world's largest hedge fund, and developing principles that have helped me navigate every major financial crisis since the 1970s. And right now, at this exact moment, I'm seeing something that keeps me awake at night. We are exactly 48 hours away from a financial inflection point that could devastate unprepared retirees. This isn't hyperbole. This isn't clickbait designed to scare you. This is pattern recognition based on half a century of watching how markets, governments, and central banks behave when they're backed into a corner. And right now, they're in the tightest corner I've seen in my entire career. If you're over 60 years old, or if you care about someone who is, the next 30 minutes could be the difference between financial security and catastrophic loss. I'm going to walk you through exactly what's happening, why it matters specifically to seniors, and most importantly, what you need to do in the next 48 hours to protect yourself. Here's what most people don't understand. The financial system operates on cycles, deadlines, and pressure points. Right now, 3 massive pressure points are converging on the same 48-hour window. When they collide, the ripple effects will move through pension systems, bond portfolios, insurance companies, and retirement accounts faster than most people can react. By the time you see it on the evening news, it will already be too late to position yourself advantageously. Let me be clear about something. I don't make dramatic predictions for attention. I've been called too cautious, too conservative, too worried about risks that never materialize. But my approach has allowed me to build one of the most successful investment firms in history precisely because I prepare for scenarios that others ignore until they're already happening. What I'm about to share isn't theory. It's based on understanding how debt cycles work, how political deadlines create market volatility, and how institutional investors behave when they're forced to make sudden adjustments. I've studied every major crisis going back to the Great Depression. I lived through the stagflation of the 1970s, the crash of 1987, the dot-com collapse, the financial meltdown of 2008, and the pandemic panic of 2020. And what I'm seeing now has characteristics that should alarm anyone who's depending on their savings to last the next 20 or 30 years. The conventional wisdom that most financial advisors have been feeding you for decades, diversify into a 60-40 portfolio of stocks and bonds, hold for the long term, don't worry about short-term volatility, that advice was built for a world that no longer exists. We've entered what I call a paradigm shift, and most seniors are positioned exactly wrong for what's coming. Let me explain what I mean by a paradigm shift. For the past 40 years, since the early 1980s, we've been living in an environment of declining interest rates and declining inflation. Every time the economy struggled, central banks could cut rates to stimulate growth. Bonds reliably increased in value as rates fell. Stocks benefited from cheaper borrowing costs. It was a beautiful 4-decade bull market in both stocks and bonds simultaneously. That paradigm is over. It ended sometime around 2021, and we're now in a fundamentally different environment. Central banks are trapped between fighting inflation and supporting an economy drowning in debt. They can't simply cut rates to zero anymore without risking runaway inflation. Government debt levels are so massive that traditional monetary policy doesn't work the way it used to. This creates unique and severe risks for retirees. Unlike a 30-year-old who has decades to recover from a market crash, if you're 65 or 70 or 80, time is not on your side. You need your money to be working safely and reliably right now. But the places you've been told to keep that money, long-term bonds, balanced mutual funds, target date retirement funds. These are potentially the most dangerous positions you could hold in the current environment. Here's why. When interest rates rise, bond prices fall. This is mathematical certainty, not opinion. If you own a bond paying 3% interest and rates rise so that new bonds pay 6%, your 3% bond loses roughly half its value. Nobody wants to buy your low-yielding bond when they can get twice the income from a new one. Now, here's the trap most seniors have fallen into. After the financial crisis of 2008, interest rates were pushed to essentially zero and stayed there for over a decade. During that time, retirees desperate for income were pushed further and further out on the risk curve. They bought long-term bonds, bond funds, dividend stocks, anything that generated yield because savings accounts and short-term bonds paid nothing. This worked fine as long as rates stayed low, but now rates have risen dramatically and they're likely to remain elevated or even rise further. Every senior who loaded up on long-duration bonds in the 2010s is now sitting on massive unrealized losses. Their bonds that were supposed to be safe have lost 20, 30, even 40% of their value. But here's where it gets even more dangerous, and this is what most people don't understand. It's not just individual retirees holding these bonds. It's pension funds. It's insurance companies. It's banks. It's money market funds. The entire financial system is sitting on enormous unrealized losses in their bond portfolios. In 2 days, on a specific deadline that I'll explain in detail, several of these institutions are going to be forced to make hard decisions about those positions. Some will have to recognize losses, some will have to sell, some will have to raise capital. And when large institutional players start moving, it creates cascading effects throughout the entire system. Let me walk you through the 3 specific triggers converging in 48 hours. First, there's a critical debt ceiling deadline. You've probably heard about this in the news, but most coverage treats it like political theater. It's not. The United States government is approaching the legal limit of how much it can borrow. Without an increase in that limit, the government can't pay all its bills. Now, the government has never actually defaulted, and it almost certainly won't this time either. But the process of getting to a resolution creates enormous uncertainty, and uncertainty is toxic to financial markets, especially bond markets. If there's even a small chance of default or even just delayed payments, it changes how investors price risk on all government debt. Here's what happens in practical terms. As the deadline approaches, something called credit default swap spreads widen. This is essentially the cost of insurance against default. When that insurance gets more expensive, it signals that the market is pricing in more risk. Other investors see this and start adjusting their own positions. Suddenly, treasury bonds, which are supposed to be the safest investment in the world, start behaving erratically. The second trigger is a Federal Reserve policy announcement scheduled for the same 48-hour window. The Fed is caught in an impossible situation right now. Inflation remains stubbornly high, which normally would call for higher interest rates to cool down the economy. But raising rates makes it more expensive for the government to service its massive debt, and it risks tipping the economy into recession. The market is desperately trying to figure out what the Fed will do. Will they prioritize fighting inflation? Will they prioritize supporting the economy? Will they try to thread some impossible needle in between? Any surprise in their announcement will create immediate volatility across all asset classes. The third trigger, and this is the one that almost nobody is talking about, is a reset window for trillions of dollars in bonds held by major financial institutions. Many banks, insurance companies, and pension funds use something called overnight repo markets to finance their bond holdings. Essentially, they borrow short-term money to hold long-term bonds, collecting the difference in interest rates. But these financing arrangements have specific rollover dates. On certain dates, The terms reset. The interest rate they pay to borrow can change. The collateral requirements can change. And if conditions have deteriorated, which they have with falling bond prices, some institutions will face margin calls or be forced to put up additional collateral. When you combine these three events, debt ceiling uncertainty, Fed policy announcement, and institutional financing resets, all happening in the same 48-hour period, you create what I call a clustering of catalysts. Any one of these alone could create market turbulence. All three together create the potential for a cascade. Let me explain exactly what that cascade looks like, because this is how most seniors will get hurt. It starts with forced selling. An institution gets a margin call or needs to raise cash to meet regulatory requirements. They start selling bonds, but when they sell, prices drop further. Other institutions see their own bond holdings losing value, which triggers their own requirements to raise capital or reduce risk. So they sell too. This creates a self-reinforcing cycle. More selling leads to lower prices, which triggers more margin calls, which leads to more selling. It's not driven by fundamental changes in the economy. It's driven by the mechanical requirements of the financial system itself. Individual investors like you watch this happening. You see your bond fund down 5% one day, then 7% the next day, then 10%. You start to panic. You think maybe I should sell before it gets worse. Millions of people have the same thought at the same moment. Suddenly, retail selling is added on top of institutional forced selling. This is exactly what happened to a retiree named Margaret that I studied. She was a smart woman, a retired teacher who had saved diligently for 40 years. She had what everyone told her was a conservative portfolio, 60% bonds, 40% stocks. She thought she was safe. Then interest rates started rising rapidly in 2022 and 2023. Her bond funds, which were heavily weighted toward longer duration bonds, started losing value. At first, it was just a few percent. She told herself it was temporary, that bonds were safe and would recover. But the losses kept mounting. 10%, then 15%, then 20%. She couldn't sleep. Every day she checked her account and saw more red numbers. Finally, in a moment of pure panic, she sold everything. She locked in her losses, moving to cash at exactly the wrong time. If she had just held on, or better yet, if she had repositioned before the crisis hit, she could have avoided the damage. Now compare that to Robert. He was in almost the identical situation. Same age, similar portfolio size, similar conservative allocation. But Robert did something different 6 months before rates started rising. He looked carefully at his portfolio and realized he was heavily exposed to long-duration bonds. He didn't panic, but he acted thoughtfully. He gradually shifted 30% of his bond holdings into shorter duration bonds and floating rate notes. He built up his cash position to 20% of his portfolio. He bought some modest volatility protection, just enough to provide a cushion. When interest rates spiked and Margaret was panicking, Robert's portfolio only dipped about 5%. But more importantly, he had the liquidity and psychological composure to buy quality stocks when they dropped 30% in the panic. A year later, Margaret was still trying to recover her losses and had lost confidence in investing entirely. Robert was up 25% from where he started. Same starting point, two completely different outcomes. The only difference was preparation and timing. This is why I'm emphasizing the 48-hour deadline. You still have time to be Robert instead of Margaret, but that window is closing fast. Now, let me give you the specific action plan. I'm going to break this down into 6 clear steps that you can execute in the next 2 days. These aren't complicated. You don't need special knowledge or access to exotic investments. You just need to act decisively. Step 1 is to audit everything you own right now. Pull up every single account. your IRA, your 401k, your brokerage account, your savings, everything. Look at each bond holding carefully. What's the maturity date? Bonds maturing in 10, 20, or 30 years are your most vulnerable positions. They're time bombs in a rising rate environment. Check any bond funds you own. Most people own bond funds without understanding what's inside them. Go to the fund's website and look up something called the average duration. If it's over 7 years, you're highly exposed to interest rate risk. If it's over 10 years, you're in the danger zone. Write down your exact allocation. What percentage is in stocks, bonds, and cash? Most people think they have a balanced portfolio, but when they actually add it up, they discover they're 75% in bonds that are about to get crushed, or they have almost no cash reserves. Look at any leverage in your portfolio. Do you have margin loans, securities-backed lines of credit, or any debt against your investments? In a crisis, leverage is deadly. It turns painful losses into catastrophic wipeouts. If you're using leverage for any reason other than a short-term emergency, pay it down immediately. Step 2 is to trim your most dangerous exposures. You don't have to sell everything. That's not what I'm recommending. But you need to reduce your vulnerability to the specific risks I've identified. If you're heavily in long-duration bonds, sell 20 to 30% of them this week. Yes, you might take a small loss now. Think of it as buying insurance against a much larger loss coming. Move that money into shorter duration bonds, floating rate notes, or even just money market funds temporarily. Floating rate notes are particularly valuable right now because their interest payments adjust as rates change. When rates rise, the income you receive goes up, and the bonds maintain their value much better than fixed rate bonds. If you have any leveraged positions, this is the time to reduce or eliminate them. I cannot stress this enough. Leverage feels wonderful in bull markets when everything is going up, but in volatile or declining markets, it destroys lives. I've watched it happen too many times over my career. Step 3 is to build serious liquidity. This is crucial. You need to move 15 to 20% of your total portfolio into truly liquid positions. Money market funds are currently yielding 4 to 5%, which is actually a reasonable return for cash. Short-term treasury bills are paying similar rates. The goal of this cash isn't to maximize returns. The goal is to create dry powder that you can deploy when opportunities arise. And trust me, opportunities will arise. When markets panic and quality assets get thrown out with the bathwater, you want to be able to buy. You can only do that if you have cash ready before the crisis hits. Think of this as your opportunity fund. When blue chip stocks that normally trade at 20 times earnings suddenly drop to 12 times earnings in a panic, you want to be the buyer. When investment grade corporate bonds that normally yield 4% suddenly yield 7% because of temporary dislocation, you want to be able to take advantage. The prepared investor with cash is calm during a crisis because they're looking for opportunities, not trying to survive. The unprepared investor is forced to sell at the worst possible time because they don't have any liquidity buffer. Step 4 is to position for multiple scenarios. This is where the concept of all-weather investing becomes critical. You need to build a portfolio that can perform reasonably well regardless of what happens next. We could get high inflation, we could get a deflationary recession, we could get stagflation. You don't know which one, and neither do I. Here's a framework that works. Put 25 to 35% in quality stocks, but focus on companies with pricing power and strong balance sheets. These are businesses that can maintain their profit margins even in difficult environments. Think about companies that provide essential products or services, healthcare, consumer staples, utilities. Put 30 to 40% in short duration or floating rate bonds. These will hold their value much better than long-duration bonds if rates continue to rise. If rates fall, they won't gain as much, but they won't lose much either. They're defensive without being dangerous. Keep 15 to 20% in cash and cash equivalents for liquidity and opportunity, as I just described. This is your shock absorber and your ammunition. Put 10 to 15% in inflation hedges. This could be Treasury inflation-protected securities, where the principal adjusts with inflation. It could be commodity exposure through funds that track energy, agricultural products, or industrial metals. It could be gold or gold mining stocks. Gold doesn't pay dividends or interest, which bothers a lot of people. But gold has maintained purchasing power for thousands of years. When paper currencies lose value through inflation, gold typically preserves wealth. During the 1970s, from 1971 to 1980, gold went from $35 per ounce to over $800 per ounce. It protected people from the ravages of double-digit inflation. Finally, and this might sound strange, put 5 to 10% in what I call asymmetric volatility protection. These are positions that actually benefit when markets panic. When the VIX volatility index spikes from 15 to 40 or 50, these positions can double or triple in value. You can access this through VIX call options if you understand options, through certain volatility ETFs, or through tail risk strategies. The goal isn't to profit from chaos. The goal is to have something that expands in value when everything else is contracting, giving you even more ammunition to buy quality assets when they're on sale. Step 5 is to set your decision triggers right now while you're calm and rational. This is perhaps the most important step of all. When the 48-hour deadline hits and markets start moving violently, you will not be able to think clearly. Your emotions will take over. Fear and greed will cloud your judgment. So decide right now what you'll do in different scenarios. Write it down. Make it concrete. For example, if the VIX spikes above 35, I will deploy 25% of my cash reserve into quality dividend stocks on my watch list. Or if investment-grade corporate bond yields spike above 7%, I will allocate a specific dollar amount into a corporate bond fund. The specific numbers matter less than having the triggers decided in advance. When panic hits, when financial television is screaming about market crashes, when your neighbor is selling everything in terror, you need something external to anchor you. That's what these written triggers provide. This is exactly what allowed me to invest billions during the 2008 financial crisis while everyone else was paralyzed by fear. I had decided in advance what conditions would trigger buying. When those conditions materialized, I didn't hesitate. I didn't second guess. I executed according to plan. Step 6 is to protect yourself from the psychological traps that destroy most investors. The greatest danger isn't the market event itself. It's your emotional response to it. When headlines scream and screens flash red, you'll feel an overwhelming urge to do something, usually the wrong thing. Here's what you must do. First, don't watch financial news channels during the crisis. They amplify emotion, not truth. They profit from your anxiety. Their job is to keep you glued to the screen, which means making everything sound like the end of the world. Second, don't check your portfolio every hour. The volatility you see on a minute-by-minute or day-by-day basis is noise. Real value emerges over months and years, not hours. Third, remember your positioning. You built defenses specifically for this scenario. You have liquidity. You have buffers. You're not exposed the same way unprepared investors are. Trust the preparation you've done. Fourth, think like a business owner, not a trader. When a quality company's stock drops 30% in a panic, ask yourself, has the actual business changed? Is Coca-Cola suddenly going to stop selling beverages? Is Johnson & Johnson going to stop making pharmaceutical products? If the business hasn't changed, The stock price is just a temporary dislocation. Let me tell you about my own experience during the 2008 crisis to illustrate this principle. When Lehman Brothers collapsed and the entire financial system seemed on the verge of implosion, we deployed billions of dollars into companies that everyone else feared. We invested $5 billion in Goldman Sachs at very favorable terms because they desperately needed capital. We put money into General Electric. These were household names that people genuinely thought might go bankrupt. The headlines were apocalyptic. Commentators were predicting the end of capitalism. I remember getting calls asking if we'd lost our minds. "Why are you catching falling knives?" they asked. "Don't you see the world is ending?" But here's what they didn't understand. We had cash that we built up when times were good. We had patience developed over decades. And we had conviction based on understanding the actual businesses, not the panic surrounding them. We weren't betting on the market. We were betting on companies with strong franchises, good management, and temporary problems. Companies that would still be here in 10 years, 20 years, 50 years. Within just a year, those investments yielded hundreds of millions in profits. Over time, some generated billions in returns. But if we hadn't had the cash ready before the crisis, we couldn't have acted. If we'd been fully invested in bonds that had collapsed in value, we'd have been frozen. If we'd panicked and sold in the middle of the storm, we'd have locked in permanent losses. Preparation created opportunity. Now let me address something uncomfortable. Most financial advisors will not tell you to do what I've just described. They'll give you the standard line about staying the course, not timing the market, and waiting for the inevitable recovery. And technically, they're not completely wrong. You can't predict exact market bottoms or tops. But here's the truth they won't tell you. Their business model depends on keeping your assets in the system. They get paid based on assets under management. When you move money around, raise cash, or reposition aggressively, it creates work for them. It generates questions from their compliance departments. It makes clients nervous, which leads to uncomfortable phone calls. So they default to doing nothing. Stay calm, stay invested, don't make changes. It's the path of least resistance for them, but it's not necessarily what's best for you. If your advisor isn't discussing duration risk, correlation breakdowns, liquidity positioning, and sequence of returns risk right now, that's a red flag. If they can't explain exactly what happens to a 30-year Treasury bond when interest rates rise 2%, they shouldn't be managing your retirement. If they're still recommending the same 60-40 portfolio they've been pushing for 40 years without acknowledging that we're in a completely different paradigm, they're not doing their fiduciary duty. You deserve clarity, not just comfort. You deserve someone who will tell you hard truths, not just pleasant reassurances. And if you're managing your own portfolio, you have a huge advantage. You can act immediately without waiting for committee approval or compliance review. Now, let me talk about the hidden opportunity in all of this, because it's not just about defense. Every major crisis creates generational wealth-building opportunities for those who are prepared. This is one of the great paradoxes of investing. When the dot-com bubble burst from 2000 to 2002 and technology stocks lost 80% of their value, most people swore off stocks forever. But those who bought quality companies at depressed valuations became very wealthy over the following decade. When the 2008 financial crisis unfolded and the system seemed on the verge of collapse, most people ran for safety. But those who could separate temporary panic from permanent impairment built fortunes. They bought great businesses at 50 cents on the dollar. This reset coming in 2 days could be your version of that opportunity, but only if you prepare. Only if you stop thinking like a victim waiting for the storm to pass and start thinking like a builder looking for opportunities in the wreckage. Here's what happens after every crisis. Markets reprice in strange, uneven ways. Some sectors get unfairly punished. Some excellent companies get thrown out indiscriminately, even though their businesses remain fundamentally sound. Whole asset classes reset to more attractive levels. Bonds yield more, offering better income. Stocks get cheaper, offering better value. That's when you move from defense to offense. That's when preparation turns into profit. But you can only make that move if you have liquidity and psychological stability. The investor who's fully invested and panicking can't take advantage. The investor with cash and composure can. Let me give you one final framework to organize your thinking. There's one rule above all others that matters. Stay in the game. You can't win if you exit permanently. You can't recover from panic liquidation. You must stay solvent, patient, and rational. Think about it in 4 simple rules. Rule number 1, protect your principal. If you lose 50%, you need 100% gains just to get back to even. The mathematics of loss are brutal. Avoiding large losses is more important than capturing every gain. Rule number 2, maintain liquidity. Without cash, opportunities are meaningless. You're frozen, unable to act when you should be buying. Rule number 3, think in decades, not days. Crisis windows last weeks or months. Wealth compounds over lifetimes. Don't sacrifice long-term compounding for short-term comfort. Rule number 4, review, adapt, and repeat. The game changes continuously. Your strategy must evolve with it. What worked for 40 years won't necessarily work for the next 40 years. That's all wealth management really is. It's not magic or genius. It's discipline, mathematics, and emotional control applied consistently over time. Now, I want you to think about legacy for a moment. This isn't just about market positioning and portfolio allocation. It's about meaning. If you're a senior, you've worked for decades. You've saved, sacrificed, and built a life. The last thing you want is to watch it erode because you weren't warned or didn't act. Think about what you'll leave your children or grandchildren. Not just money, but wisdom, stability, and the lesson that preparation matters more than prediction. When I emphasize that you have 2 days, I don't mean it as fear-mongering. I mean it as focus. You have 48 hours to review, reposition, and secure peace of mind. You have 48 hours to decide whether you'll be Margaret, watching value vanish in panic, or Robert, calmly navigating chaos with a plan. That's the choice before you right now. Let me summarize the entire action plan one final time so you can execute it. First, audit everything. Know exactly what you own. Identify long-duration bonds, bond funds with high duration, and any leverage. Second, trim dangerous exposures. Sell 20 to 30% of long-duration bonds. Reduce or eliminate leverage completely. Third, build liquidity. Move 15 to 20% into cash, money market funds, or short-term treasuries. Fourth, diversify adaptively. Balance across stocks with pricing power, short-duration bonds, inflation hedges, and volatility protection. Fifth, set your triggers now. Write down specific conditions that will prompt you to deploy cash into opportunities. Sixth, prepare psychologically. Decide now that you won't watch financial news obsessively, won't check your portfolio hourly, and will trust your preparation. If you execute these 6 steps in the next 48 hours, you will not just survive whatever comes next. You'll be positioned to potentially profit from it. You'll have the liquidity to buy when others are forced to sell. You'll have the psychological stability to act when others are paralyzed by fear. You'll have the diversification to perform reasonably well, regardless of which scenario unfolds. This is how you transform from being a passive investor, hoping for the best, into an active pilot of your own financial future. This is how you sleep soundly at night, regardless of what's happening in markets. This is how you protect your life's work and potentially grow it, even during turbulent times. The deadline is real. The risks are real, but so is the opportunity for those who act now rather than react later. You have 2 days. Use them wisely. Review your positions today. Make your adjustments tomorrow. And rest easy knowing that while others are scrambling to react, you already prepared. Thank you for your time and attention. I hope this has given you clarity about what's coming and confidence about what to do. Stay rational, stay prepared, and remember that in investing, as in life, fortune favors the prepared mind. I'll see you on the other side of this reset.